Hello fellow investors. In this video, we'll be looking into the big banks' earnings because they've been ripping to the upside lately. Were their earnings report really that good? Now, before we go on, I must first say I haven't worked around their free cash flows yet. Only the net income, EPS, and their revenues and margins. To be honest, financials, especially banks, I find their financial statements harder to understand. But anyway, we'll look into it and I'll discuss some things after. First bank is JPM. This is their earnings snapshot, the second quarter. Their revenues grew 0.77%. They missed revenues expectations, but for me, growth is still growth, and that's good. But look at their EPS, quarter over quarter, 3.78 to just 2.76. It went down. Analyst expectations were 2.89. They were really expecting some drop in the EPS, but they reported much lower than the estimates, which is just bad. Look at their net income. Compared to last year's, it's down 27%. And the net income margin fell sharply from 39% down to 28%. EPS trailing 12 months decreased 8%. I guess that explains the gap down on earnings. But since then, it ripped to the upside. I'll explain that one out later in the video, why it ripped despite having terrible earnings. For now, we've established JPM's earnings were bad, excluding the free cash flow, of course. Second bank is BAC, Bank of America. It's the same with JPM. Revenues increased 5.69%, but the EPS dropped from 1.03 to 0.73 quarter over quarter. The net income dropped 32%. The margins dropped from 43% down to 28%. EPS trailing 12 months dropped 8.57%. The stock got up anyway on earnings. I'll explain this one later in the video. For now, we've established that BAC's earnings were bad as well. Again, excluding the free cash flow. Third bank is Wells Fargo, WFC. All red. Terrible earnings from top line to bottom line. Revenues decreased 16%, net income decreased 48%, and margins decreased from 30% down to just 18%. EPS trailing 12 months dropped 13%. Terrible earnings for WFC. Excluding the free cash flow, it's important to note that. Chart-wise, it's been ripping. The stock even gapped up on earnings. Why is that? Last bank is C Citi Group. Revenues increased 10.62%, but EPS quarter over quarter decreased from 2.85 down to 2.19. Net income decreased 27%, and net income margins decreased from 35% down to 23%. Terrible earnings as well for C Group. I'll answer the questions now. How come I'm saying they have terrible earnings, yet revenues are up? Guys, I am an investor. You are an investor. We don't pay for revenues. We're not the government. Government get their taxes on fixed rates. It's good to know that they're growing their revenues though, but we buy stocks for the money they're making. The net income, the free cash flow, the EPS, their margins, that's what we're paying for. That's why when I say it's terrible, it's because their net income, their EPS, their margins drop. And that's not a good earnings report. At least not the combination I'm looking for. I'm okay with them not growing their revenues. It could be at zero growth, negative, but it's important that the net income, margins, EPS remains at least the same, or it grew quarter over quarter or year over year because I'm valuing companies on trailing 12 months basis. Now, why are these earnings ripping to the upside if the earnings were so terrible? Before I answer this, let's look first at the chart. The 5-day chart. They moved the same way. Even if they reported earnings, you've seen it, Wells Fargo's earnings were bad, terrible. Why did it rip? When I see movements like this, the initial answer that comes up to mind is someone's buying the SPY, or the ETF that contains these banks. A market mover, perhaps. My second answer is, guys, fundamentally, these banks are way undervalued and trading just a little above 1 PB. Some even trade way below 1 PB. This could be a relief rally or a dead cat bounce or a traditional bear market rally. They were oversold anyway. And lastly, guys, the consumer spending is still alive, strong and kicking. You've seen their revenues. They're all up, except Wells Fargo. It doesn't feel like recession to me. That could be why the stocks are reaping to the outside. If we're to look at a higher time frame, one could even argue that these terrible earnings were already baked into the price. And I may totally agree. As I said before, fundamentally, these banks are undervalued. And them shedding 20% doesn't make much sense, especially when rates are going up. If we're talking just valuations, their earnings report compared quarter over quarter and year over year, and if the markets haven't priced in these terrible earnings yet, the play is to sell this rip. If the tech stocks reported such terrible earnings, I won't be surprised that these bank stocks would be dragged along them.